Good afternoon, everyone. Thank you so much for making the time to join this important webinar on how to leverage AI for implementing the important standard of IFRS 18. Friends, we'll be with you shortly. We'll just wait for some of our participants to join. We will be with you in about a couple of minutes. Okay, let's get started. Welcome everybody. A very good afternoon and a very warm welcome to today's webinar. My name is Nirav Patel. I'm a partner with Uniqus based in Mumbai, India. I am joined by my very able co-presenter Nishant Sayani. And over the next 60 minutes, Nishant and I will unravel how do we leverage AI in implementing IFRS 18. As you all know, IFRS 18 is a standard which is imminent in its applicability. It replaces IAS 1, and it is going to be a very, very important change, especially in the realm of financial reporting. Before we get started on the webinar, a few very quick housekeeping rules. Do drop your questions into the Q&A panel anytime during the currency of this webinar. We'll try and address all of them simultaneously. And if we are unable to, then we'll kind of send a summary of those questions, and drop it in your inbox. The session is being recorded. So that anybody who needs an access to it and this can be made available later on. And with this, let me get started quickly. As I said, IFRS 18 is one of the most important, significant changes to the whole financial statement preparation. It replaces a 3-decade-old standard of IAS 1. Which several users of financial statements were starting to kind of express their disappointment that IAS 1 gives too much of latitude. It prohibits in some ways the key tenets of IFRS, it is not that transparent. It does not aid comparability fully. And there are various versions of truth, and the usability thereby is not at its best. Hitherto, thus far, companies used to have a bridge where they used to give certain amount of information to their investors and other stakeholders by means of investor communication, investor calls, or management reportings, or MD&A, etc., etc. That took away the entire purpose of a set of financial statements, which should be a single source of truth for the financial performance of an organization. So that in some ways went against the grain for which the financial statements are purported to kind of achieve. And hence IFRS 18 was introduced. It has been in the making for several years. The IASB, the International Accounting Standards Board, has been extremely deliberate in what they want to kind of achieve and how they want to achieve these tenets, which I just spoke of, so that a balance is achieved between what is relevant and what is it that is the art of the possible as far as the financial statements are concerned. For the purpose of this discussion, I'll split it into two parts. The first one being I'll walk you through some of the key changes and give you an overview of the key changes that IFRS 18 has brought about. And thereafter, my colleague Nishant, he'll walk you through how the AI can be leveraged in implementing IFRS 18. How do you really develop use cases which can bring in productivity, which can bring in efficiency, which can bring in a very, very quick sideways glance, of what one aims to achieve. So we'll kind of split that into two parts. Just for relevance and setting the context, I will use a few set of slides and take you through the key changes as far as IFRS 18 are concerned. As I said, if you have any questions, please do drop into the Q&A box, and we will forthwith attempt to respond to your questions. With that, what you see on your screen are the real key highlights or changes as far as IFRS 18 is concerned. This is IFRS 18 on a slide. The first important change, if I were to kind of drill down, is on classification of income statement. Again, a long-standing demand by the stakeholders and investors was to really know what is the income or losses or profits that an organization has been able to achieve from its operations, from its core activities, from its activities that it is set up to achieve. Second, they wanted to understand what is the income or losses that they are making from really the investment activities or any sort of surplus money that they have parked in financial assets. They wanted to clearly distinguish between the two. And the third important thing that investors were looking for was really to see what is the impact of how an entity is funded on the performance of the entity. So these three things were constant refrain, constant demands from the users of financial statements that they have to be disclosed. What companies used to do? Companies used to give out, as far as investor reporting is concerned, their core profit or core income as metric. But by doing any of those activities, it is of course inconsistent between organizations. Organizations tend to kind of define what is core, what is non-core, based on convenience, and several inconvenient or awkward sort of numbers could have been hidden under the carpet. So to avoid all of that, or to make sure that there is, as I said, a single source of truth and comparability between preparers of financial statements, the income statement under IFRS 18 will now be categorized into operating, investing, and financing activities. They've also added two mandatory subtotals for getting the operating profit and loss, which is a very important metric, as I said, and also profit or loss before financing and investment activities, so that then the impact of everything else is kind of known. More on this later, but just to set the context, this is an important change. It seeks to address the long-standing demand of the users of financial statements. It aids comparability, it brings about transparency, and more importantly, it kind of helps giving relevant information to the users of financial statements. A corollary of this is what is known as the main business activity assessment, where the standard essentially states that you please contextualize what your organization is set to achieve, what is its main business activity. And it just very, very intuitively splits that between companies which are in the business of providing finance to customers, say a bank or a lending NBFC. Um, Companies which are in the business of investing into assets, say an asset management company, fund, etc., and others, because it really, the board thought through and said that if you kind of cut through all the clutter, really these are the three distinct sort of sets of businesses where the outlook in financial performance terms could be very different and has a forbearing on what is termed as operating, what is termed as financing, and what is termed as investing in that sense. So the main business activity assessment, as I said, is fairly intuitive. It's a fact-based assessment. In most cases, it won't require judgment, but in some cases, it does require a judgment, especially in case of conglomerates, where the assessment could be different between a subsidiary, which is, say, in the business of investing in assets, and the parent, which could be in various businesses, so on and so forth. So the assessment could change as you kind of move to consolidated financial statements. The third important element, which underwent an important change, this again addresses the whole issue of transparency. This standard now brings about fairly detailed guidance and in somewhat very, very detailed sort of guidance and rules on how do you aggregate and disaggregate items in the financial statements. What is the real purpose of a set of financial statements in terms of the notes? What is its relevance in terms of the face of the financial statements, which could be your income statement, balance sheet, cash flows, etc. How do you structure both of them? How does aggregation work at the front end on the face sheets, and how does it disaggregate as you move forward? Although also one of the important elements is that the users of financial statement reached somewhat a level of frustration with several organizations where they used to bury a lot of relevant material sort of line items under the garb of obscure terms like other current asset, other operating income, other operating expenses. So all those inconvenient sort of aggregations into obscure line items like others, is now kind of not going to be permitted in a big way, and hence there are rules which surround that. Again, more on that later. The next, and if you were to ask me honestly, the most important element that underwent a change is in the disclosure of management defined performance measures. One of the most keenly watched, hotly debated topic when the whole standard was being written was this topic on management defined performance measure. On one hand, the ISB was kind of drawn into the fact that a lot of information was provided outside the financial statements to the investors, to various stakeholders, so that they can better appreciate the financial statements. And that kind of moved away from the basic fact that these financial statements ought to give whatever information companies are looking for, or whatever information investors are kind of looking to evaluate the performance of the entity. So they brought in this concept, or they wanted to bring in the concept that such sort of non-GAAP measures, which are used by companies in investor reporting, should form part of the financial statements, and as a result be subject to audit, be subject to a deeper level of scrutiny. Now, there was a huge trade-off between achieving the objective in a gold standard, where everything an investor wants is rightly available or readily available in the financial statements, and the cost versus the benefit of doing so, the auditability of doing so, and in doing so, how does one achieve in a core objective without kind of boiling the ocean? So that was the trade-off. That is the kind of dilemma that the ISB had. But within those constraints, they kind of brought out a very detailed guidance on what constitutes management-defined performance measures. So what are those measures which are adjacent to an income statement, which is important, which management thus far has been sharing in its public commentary, and which are so important so that they could be brought in the financial statements and then be subject to audit, so that the information that goes out is kind of tested through a detailed scrutiny by the audit and then the governance function of the organization, which is the audit committee and the board. So the objective was to kind of make sure that the financial statements again become a single source or single version of truth, and not too many inconvenient things are hidden or being dropped by companies whenever the numbers don't favor them. So that was the entire objective of management defined performance measures, which we talk about in some detail in a future slide. Last again, they kind of made some of the more sort of consequential amendments to cash flow. Detailed look at the cash flow like standard is under development by the ISB, but pending that, some of the more consequential amendments made it to the cash flow statement, with the starting point for operating, financing, investing activities. As you know, the cash flow using indirect method also now in some ways replicates the income statement under IFRS 18. So the starting point for cash flow from operating activity quite intuitively will now become operating profit or operating losses, and then all other adjustments to kind of get to operating cash flow will work that way. And of course, there has to be alignment between what you're calling as investing and financing activities on the P&L, and does that warrant any change or reassessment in calling those items like interest and dividend in the cash flow statement. So there'll be a complete sort of parity between what is shown as operating, investing, financing in income statement versus that in the cash flow statement, right? The other important thing, before I proceed, that they brought about in the balance sheet is to show goodwill separately on the face of the balance sheet. Goodwill, friends, as you know, is an important determinant. If one were to look at the asset side of the balance sheet, several companies who have been done acquisitions recently have had very, very large goodwill that hides somewhere on page 538 of the annual report. So it's an important measure gets buried under a lot of data, and in years where there is an impairment of goodwill, that certainly shows up and comes for a lot of times as a surprise. So now they have kind of brought eminence to goodwill and upgraded it to the face of the balance sheet. So those would be, to my mind, some of the most important amendments or changes that IFRS 18 will kind of bring about in measuring the performance and looking at the statement of position of an organization, who prepares financials under IFRS. We'll deep dive into 2 or 3 concepts before I hand over the floor to my colleague Nishan to take you through how the whole thing, in a very congruent manner, matches into the AI sort of world. The first change, as I said, is the classification of income statement. Now the income statement will be split into 3 categories: operating, investing, and financing. Those of us, who are used to seeing a cash flow are pretty familiar with what is operating, what is investing, what is financing. It's very, very intuitive to kind of know what falls into each of the categories. Quite interestingly, they have called operating category as a residual category. So they have a few more defined sort of criteria or rules around what goes into investing, what goes into financing. And as a corollary, the operating category becomes in some ways residual. This is to kind of otherwise, get companies to kind of show something which is not convenient to them and slip it under any other category. So they have kind of quite deliberately put operating category as a residual thing. So operating category will include income items of income and expenses, which relate to an organization's main business activity. So if you are a company that manufactures automobiles, so all the income and expenses relating to that activity will be considered as operating in nature. Investing category would be used for looking at the income and losses that got generated from the investments that the company has in financial assets. And also it will include all the income and expenses or profits or losses from equity accounted investments, and any other financial asset that a company may hold, right? The third category is the financing category. Essentially, this is to, as I said, let the users know as to what is the impact of how the organization has been funded. What impact does that have on the performance of the organization? So companies with a very high leverage, will start reporting interest cost in the financing category, and that way it will help organizations to kind of measure the performance and measure the leverage and measure how companies have been kind of organized, for the purpose of their assessment. So very neatly, it requires you to calculate your income and expenses, or categorize income and expenses into these three categories. And to my mind, I think it's a step in the right direction. A lot of investors, the way they analyze, or the way analysts analyze the organization, they also pretty much mirror the thinking on operating, investing, and financing. So this, in some ways, brings about congruence between how the investors think and how the company presents its items of income and expenses, so that there is no cherry picking, there is no sort of uncomfortable or awkward sort of information being kind of put into any other sort of residual category, so on and so forth. Right. So that's the entire purpose. On the right hand side of the screen, you will see just like a snapshot of a profit and loss account. As I said, now the format of the profit and loss will look something like what's on your screen. More importantly, a couple of important changes. One is the whole subtotal on operating activity, or operating profit or losses will have to be shown, and an additional mandatory subtotal on profit before financing and income tax will have to be shown. So there'll be a line item for operating profit, a subtotal then for profit before finance and income taxes. Then everybody was used to seeing profit before taxes, and thereafter profit for the year. So this is how essentially the face of the profit and loss will be kind of look like. And organizations across the globe will be kind of presenting it in a similar fashion, which will help ensure comparability and consistency. Moving on, the next important change would be on the whole aggregation and disaggregation. Again, won't spend too much of time. I did touch upon this aspect. The idea really is that items which have similar characteristics, which are homogeneous, have to be aggregated, and items which do not kind of have any business to be together, the material items, I must admit, should be disaggregated, so that the picture becomes very, very clear to the user as to what is going on in a particular financial statement line item, and whatever purpose that particular line item was supposed to convey, that is conveyed in an unambiguous manner. So that's the spirit behind the whole aggregation and disaggregation requirement. So within the standard, you will see there are characteristics of what constitutes or what are the items that can be aggregated. Similarly, characteristics of what should be disaggregated. As I said, it gives a proper role for what should be included as a structured summary in the primary financial statements, and how do you then disaggregate into as you go along into the notes which accompany the financial statements. Right. The core purpose is not to kind of obscure information, and things like other income or other expenses which sometimes are kind of not comfortable, will now be discouraged in some ways. The nature versus function, largely they've kept that thing to be largely consistent. You have an option to do that. There are certain line items which they mandatory require to be disclosed in the notes to accounts if you're following one versus the other. So things like depreciation, etc., are kind of mandatorily to be disclosed, irrespective of whether you follow by nature or by function. And a certain amount of hybrid nature is also permitted. So you can present something by function, something by nature. But again, there are detailed requirements for what follows in the notes to account, so that the key kind of information is not lost with what a particular entity chooses to present. Next slide, please. As I said, the most important thing and an area where there was a very, very tightrope walk by the ISB has been on management defined performance measures. These essentially are subtotals of income and expenses. I'll repeat, they are subtotals of income and expenses, nothing to do with the balance sheet or cash flow, which are found outside the financial statements, which have been used in public communication, public commentary, through your investor presentation, through your MD&A, etc., etc. And those, thus far has been used in communicating management's view of financial performance. Now will have to be very carefully considered as part of the financial statements, and thereby undergo audit and all the governance related step up that is required. The idea here, as I said, it was to say that look, if management thinks that this is an important measure, then it is definitely an important measure, relevance over anything else. So that is the logic why performance measures, or MPMs, have to now be disclosed in the financial statements. Equally, as I said, the amount of deliberation that the IASB went through on this topic resulted in not just what constitutes an MPM, also it focused a lot of attention on what is not an MPM, so that it is very clear, both by virtue of inclusion and exclusion, that what really comes, think of it as a Venn diagram, what comes at the intersection of it, will be something that will be in some ways disclosed. So what is not an MPM? So what is not an MPM definitely is not something which is an existing subtotal in the income statement, because that anyway is available, like gross profit or profit before tax. That's not an MPM because that was always there in IFRS. It is a subtotal of only income or only expense. So if you have only revenue or revenue from this particular line of activity or revenue from this particular sale of products, will not constitute an MPM. It has to be a combination of income and expenses. Okay, so just one part of the income statement will not constitute an MPM, I beg your pardon. It has to be a combination of two. It does not include ratios. Okay, it just includes subtotals within an income and expense, which will then have to be married, into a reconciliation. So it does not include ratios. It does not include any performance measure which relates to a particular segment. So that is not included. It has to be for a financial statement as a whole. It does not include non-financial measures such as user base, fleet size, or any such acreage, or any such non-performance measures. Those are not kind of considered as MPM. Those have to be outside the financial statements, and they were and they continue to be outside the financial statements. It does not include, as I said, balance sheet measures or measures of cash flow or liquidity. those are again kept outside the ambit of MPMs. So it's a fairly narrowly defined sort of a measure. And as I said earlier, this was to basically make sure that there is benefit and the cost do not outweigh the benefits of putting something as an MPM, and it does not vitiate auditability of the entire reporting in that sense. Just to ensure again some amount of discipline, they have put stringent disclosure requirements. So if all MPMs have to be disclosed, in one note. You have to explain what that MPM shows, how it relates to the IFRS numbers. So to provide a reconciliation. Say, for example, you want to show an adjusted EBITDA, and you don't want to include, say, a non-operating item of income or an expense. Then you just have to provide a reconciliation from your nearest income statement, the most relevant item of income statement, onto the MPM. Right? You have to define what that MPM is and why management thinks it is important and how do they leverage or use it. Most importantly, if you are dropping an MPM, not reporting it, you have to kind of let the users know that I have not kind of used this particular MPM, which I was thus far disclosing. This is again an anti-abuse mechanism. So if some number is uncomfortable, inconvenient, management can't willy-nilly just drop that. You just need to give better reasons why one is doing so, and of course that has to pass the test of audit as well. So they've put in further amount of sort of guardrails around MPMs through the disclosure requirements as well. So that's essentially what the MPMs are, and we'll see in practice how this will kind of work. Some of the examples of MPM would be adjusted EBITDA or profit before research and development activities, or EBITDA before non-operating income and expenses. So it will be items of those nature, right, which are important enough to be communicated, but are a measure of income and expenses put together. Right. Move on to the next slide, please. Yeah. Now, just coming to the core, as I said, the second part of our session. How do we, in today's day and age, leverage AI in helping all of what I discussed, or most of what I discussed? How do we leverage AI? How do we kind of make the most, of the amount of advancements that various LLMs have made in enabling or in bringing about productivity, in bringing about efficiency, in bringing about sideways glance and comparability between your peer sets very quickly using AI, rather than going the old school way of actually going through line item by line item and kind of applying your judgment. Of course, this does not take away the human in the loop element from it. There are several elements here which do require judgment, but think of larger conglomerates with many subsidiaries. Using AI will definitely bring about efficiency, reduce grunt work, and bring in auditability as far as IFRS 18 is concerned. To this end, we have kind of codified those elements of AI, leveraging AI into our tool, and we can just demonstrate that how one can leverage AI for implementing IFRS 18. And to do so, I hand it over to my colleague Nishant. Nishant will kind of do a live demo of how this tool will work in action and how do you kind of leverage the power of AI in implementing IFRS 18.
Sure. Thanks, Nirav. Before we kind of go there to the tool, I just set context quickly. See, broadly, the way we look at it, we are at the intersection of two of the most consequential kind of changes, relating to the finance function. A fundamental change in terms of how the financial performance is being presented and disclosed under IFRS 18, the rapid emergence of AI as a serious, enabler in terms of financial reporting. Our objective, essentially is to explore how these two forces come together and what it means for the finance leaders preparing for the transition in that sense. And Nirav kind of covered initially in terms of the different nuances in terms of how the P&L will undergo change in terms of presentation alongside disclosure of MPMs in that sense. For the finance team, this calls for a detailed re-examination of chart of accounts, reporting hierarchies, internal management reporting, and public disclosures. Each line item must be revisited. Every MPM disclosed externally must be reconciled and justified, and every judgment must be documented. In short, the work is complex, time-consuming, and deeply judgment-intensive. And for large and multinational organization, the scale of this exercise can be very, very, very daunting in that sense. And that is precisely where AI has a meaningful role to play. AI is not a substitute for accounting judgment, and it should not be also, but it can fundamentally change the economics of how an IFRS 18 transition is executed. Specifically, AI can help finance teams in four important ways, broadly, if you were to just look about it. In accelerating data analysis at a scale, that it can process large, volume of information very quickly, rapidly, bringing consistency to classification for a large, diverse organization. It can kind of have the same logic, process the information, and apply the same logic every time, every entity in that sense. It can rapidly scan through public information, public disclosures for the identification of MPM. AI can also be embedded in a tool in a way that it can give a audit-ready output in the sense. We will see in the tool also how it can produce audit-ready output alongside maintaining an audit trail of whatever are the changes made in the process. Needless to say, AI does not replace human. It is imperative to have human in the loop. It does not replace the judgment. However, what it does is remove heavy lifting, the data wrangling, the repetitive classification, the document review, so that human intelligence is applied where it matters most, on interpretation, on judgment, on disclosure quality. The most effective IFRS 18 transition in our experience will be the ones that combine deep accounting expertise with intelligent automation, not one or the other in that sense. At Unicus, what we have done is we have essentially codified prompts into an AI automation tool. Essentially, it is a purpose built tool to simplify and accelerate IFRS 18 implementation. The tool combines deep accounting expertise with intelligent automation to deliver a faster, more controlled, and higher quality financial reporting process. Our objective today is to demonstrate how the combination of deep accounting expertise and intelligent automation can take what is traditionally a heavy manual and judgment-led exercise and turn it into something that is structured, scalable, and significantly more efficient. So without further delay, I'll just get the tool presented, and then we can take through the tool in that sense. Sure. So what you see on your screen right now is the tool that we have developed internally, essentially helping companies in diagnostic and IFRS 18 implementation process. So first we will look at how do we do the P&L classification through AI capabilities. So in the first assessment, as we begin, the input that is required, I mean, essentially, we need to kind of log in through the credential. And as we go on the input page, the first analysis that we'll be doing live is in terms of P&L classification. This is the page where all the necessary inputs are required to be updated on the page, starting with the name of the analysis that we are doing, then the necessary documents that are required to be uploaded. For the purpose of P&L classification, the input which is required is the trial balance. Trial balance essentially should have the three inputs: the GL account number, the description of the GL, and the existing mapping of chart of accounts. What the tool essentially will do is that it will basis the description of the GL and the knowledge base in that kind of fed in the tool. it will reclassify all the existing GL into three different categories, and we will see in the output also in that sense. So we are selecting the step three, the analysis that we want to run at this stage. If we just go further down, here we need to select sector, and why this is required is that there are different different classification which are relevant for that specific industry. That is also inbuilt in the knowledge of the tool in the sense. So here we will select a company. So we are running this on a representative company in the business of oil and gas industry. So that's why we are selecting manufacturing kind of sector. Yeah. And here we need to again select provide a description of the nature of industry, the business, which is carried out by the company in that sense. In the next step, most importantly, Nirav covered initially is the selection of main business activity. If it is a financial services, some of the income which otherwise could be operating, otherwise could be financing for a manufacturing company, could become operating for the financial services kind of company. So that's why it is very important to select the main business activity of the company for which the analysis is being done. Here in our example, we are performing an analysis for a manufacturing company, and hence we are going to select a other because it is not falling into any of the specified main business activity. If we just further go down, again, we will kind of give a description in terms of business activity of the company. Yeah. And the last step 6, if you see, while building the tool, what we have ensured is that we have in the knowledge base, in the repository, we have uploaded all the necessary and the relevant document in terms of bare standard, basis for conclusion, IFRS, IFRIC interpretation kind of papers, and all the relevant publicly available Big Four issued publications. So if a particular user wants to run analysis basis, guidance provided by any of the specific accounting firms, you can select that guidance also, and then tool will refer to that guidance and run the analysis that way. Here, for us, for a representative purposes, we are select EY as a kind of knowledge provider for running the analysis in that sense. Yeah. So it is just press of a button, tool will start, going through the trial balance, mapping it with the IFRS requirement, and then we'll kind of give the output. In the interest of time, while it will take few minutes to run the output, we will go through the output that is already ready in terms of how the PNL will kind of look like after the analysis. What you see on the screen is the output screen, where column first 3 columns are as per the existing trial balance, what was uploaded initially. And then column 4 essentially highlight the new category where the particular GL should be classified under the revised IFRS 18 profit and loss account. To see the revenue is operating category because it is a manufacturing company. If you just go further down, finance expense will be classified as a financing activity. If Forex, and there were a few questions of the chat and Q&A also. The foreign currency is an item where a detailed analysis and a breakup is required because the foreign exchange gain and loss relating to item which is classified as operating will go to operating category. If it relates to item which is classified as financing, then the foreign exchange gain also will get classified as a financing category in that sense. If by reading the description of the GL, if tool is not able to get the clear understanding in terms of whether it is operating or financing, by default, and as is the standard, it goes to operating, and then it provides a specific kind of answer, remarks for the user to look at it, and then accordingly take action in terms of whether Forex is to be classified as operating, investing, or financing in that sense. Also, as we said, it provides an audit, ready output. And also, we said that human in the loop is extremely important. So this is why for all of this tagging of GL, there is a capability in the tool where a user can review, change the classification, change the description also. And any changes made after the output is generated, all the changes are being tracked in the audit trail. At the same time, reviewer, the first level of reviewer has capability to review this submit this to another kind of higher level reviewer for their comments and kind of confirmation in that sense. So there could be workflow based approval mechanism also in the tool to kind of do this in that sense. So any changes in the tool are being tracked and then it kind of go through workflow based approvals. Uh, a user can also download this into Excel, PDF, whichever form and manner required to kind of do the further analysis outside the system as well. So the broadly idea is to highlight if there's somebody were to do this analysis, do this tagging outside the system manually, it would take significant amount of time to scan through thousands of GL account and then map this. But with the use of AI and using the capabilities of AI, this activity can be completed within few minutes, and then additional time can be spent by user in terms of applying spending time in the areas which require judgment in terms of analysis and reporting in that sense. Any question, you can just keep posting on the Q&A and then our team will kind of respond. In the interest of time, we will just switch to another analysis relating to management defined performance measures, MPM. Yeah. Anish, if you can see if the earlier output is generated in the tool by the time we are. Yeah. Yeah. You can see that their output is also kind of generated. So it hardly take few minutes to run the PNL classification analysis. Okay. Now let's start the MPM analysis. You can just go to run the new analysis. Yeah. And that now we are running MPM analysis. So here we are using RIL as a reference and we'll be using all the information which is publicly available in that sense. Most important thing in any MPM analysis is to define the boundary of public documents. So one is to decide first in terms of what are the information, what are the documents through which information is disclosed publicly, and then pull all of those documents, a PDF document, and then upload in the tool and kind of select from the drop down this document relates to which category. Could be investor presentation, could be annual reports, could be earning releases in that sense. Then at the step 3, user need to select in terms of what analysis is being performed in that sense. So we select MPM identification, and then similar to the P&L classification, here also we select sector and industry, which kind of gives additional information to AI when subsequent analysis is being performed in that sense. Yeah. In terms of documents, currently we don't have any limitation. If there are, let's say, 4 documents in terms of annual reports, investor presentation, quarterly earning release, or any other documents where the information is being disclosed publicly, it could be quarterly, earning release or close 33 results. All of those can be uploaded simultaneously together in the chats. Yeah. So now we run the analysis. Yeah. Again, it will take few minutes to run the analysis, but before that, in the interest of time, we look at the output in that sense. Yeah. So if you see the most important thing in MPM, and because this is being disclosed for the first time, in the financial statement, the most important thing for anybody to ensure is the completeness of all the performance metrics disclosed outside the financial. Because as you would realize that there are 3, 4, 5 documents running into hundreds of pages. If anybody were to look at it manually in terms of all the MPMs or performance metric disclosed, it would take significant amount of time. Besides, it will also there will be question in terms of completeness of all the MPM or the performance metrics kind of listed down. So what tool will do, if you can just go down at the bottom of the page, it will highlight what are the KPIs or how many performance metrics disclosed all across the documents publicly. Right? This is step 1. So this analysis has picked up there are 77 KPIs, performance metrics disclosed outside the financial, out of which basis the IFRS 18 definition of MPM, which Nirav covered earlier in terms of the disclosed publicly subtotal of income and expense, and communicates management view of performance of the company as a whole. If any metrics is falling within the definition of IFRS 18, then it becomes MPM. Now, tool is identified there are 4 metrics are considered as MPM. This is the definition. Rest 73 are not an MPM. And if you see the last column, the tool also gives remarks in terms of why it is MPM or why it is not an MPM in that sense. So EBITDA, if you see, EBITDA is an MPM because it's subtotal of income and expense, and that's why it is classified as it is an MPM. Again, another very useful feature in the tool is that if you click on the page 6, it will straight take to the page of the annual report of any of the PDF document uploaded where the metric is disclosed in that sense. So very, very useful and handy in that sense. Description is highlighted in the definition why it is an MPM. And then the IFRS reference. So which para in the IFRS standard, because of which this is becoming an MPM, this reference is also kind of given here in that sense. If we can just go down, we'll just look at a few examples. So yeah, the revenue as you we discussed earlier, revenue is not in subtotal. Adjusted revenue is also not in subtotal. It will not be an MPM. Digital service EBITDA. Now, if you see here, EBITDA is an MPM, but digital service EBITDA is a particular sector or segment of the company or business of the company. It is not. It does not communicate management view of the company as a whole, and that is why it is not MPM. You can see the description also. It has been classified as not an MPM. Similarly, retail EBITDA is also it is a subtotal, but it is not a company as a whole. That's why it is not an MPM. O2C EBITDA, and if you just go down, there are certain operational KPIs which are non-financial metrics. Again, relevant, very useful for the stakeholders, but it does not fall within the definition of MPM under IFRS 18, and hence data traffic, ARPU, subscriber, relevant KPIs, but not an MPM within the definition of IFRS 18. That's why all of those are kind of tagged as not MPM. So similar to the P&L classification here as well, user has capability to make any changes as needed. At the same time, there is a comment feature. So if second level reviewer wants to comment and submit it back to the first level, prepare for any further analysis or any edits or any rerun, those comment facility is also there in the tool in that sense. So that's why the objective was to make it in a way where output is very audit ready. There is an audit trail in terms of what are the changes done, in the system after the first analysis is run in that sense. If you see the download this thing, and we can download the PDF Excel, and if you download PDF, the document is absolutely formatted in a manner in which one can immediately kind of send to relevant stakeholders for the further analysis, review, and confirmation that way. Yeah. We can see the output also. Yeah. 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 So that way, the idea again, just going back to the tool, is to highlight that how do we unleash AI capabilities to run some of these analyses, which are very time intensive, and at the same time very difficult to ensure audit trail in a Excel kind of environment. So that's why wanted to highlight or wanted to showcase how we can kind of use AI to do some of these analysis and then do the diagnostic of IFRS 18 very, very quickly in less than a week's time. Yeah. Niro, anything you want to add here?
No, I think this kind of highlights importantly. The idea really was to kind of showcase how quickly and easily AI can be leveraged to sift through multitude of data points, information, to ensure that nothing gets missed out. Through very sharp prompt engineering, you can write prompts which ensure parsing of all elements of an annual report or any documents that one may kind of upload. And this can also be used to do a compare and contrast. I mean, if you can upload your peers' financial statements, that will give you very clearly what the peers are reporting and what could be their MPMs very, very easily at the click of a button, so that you are not reporting something which is completely out of sync with what your peers are doing. So very quick sideway glance into what your peerage is doing is very, very easy. You don't have to kind of employ multitudes of consultants or analysts to kind of do that. It white labels where the information is being searched from. Unlike searching the entire web, where pretty different myriad sort of people would have posted, and the LLM reads and interprets those as well. This kind of provides a lot of good guardrails and a boundary as to what constitutes a proper authoritative guidance. This is also keeping in mind the requirements of the auditors, because they would want somebody or some guidance which stands the test of in some ways being authoritative, and the interpretations are well thought through. So all of those things can be very easily done, as you saw, within 20 minutes on something as large, as Reliance Industries Limited. So that is something that you can very, very quickly do, and that's what we showcased. How do you leverage AI in doing so? There were a lot of questions around saying that why do you need a tool, and can't this be done openly on a platform? Of course it can be. Of course. What we are doing is also, this is based on Google Gemini. That's the LLM that this particular tool uses. But what happens, where does domain and technology collide, is in prompt engineering, is in writing the prompt in a way in which the standard is intended to kind of interpret, or the standard intends to achieve. So that's the prompt engineering. And also, where does it look for? Does it look in the entire web world, or does it look in some sort of a finite guidance? So the more you are able to contain, the more you're able to train the model, the better the output and better the auditability of the output is going to be. Think if you have to do P&L classification across 150 companies in your group, if you're a conglomerate, that is an exercise which will take days and months. Through leveraging AI, this can be done very, very quickly. Similarly, as I said, for MPMs, a very, very good starting point can be built using smart prompt engineering, which is what we intended to kind of showcase today. And of course, you can build this by yourself on any of the LLMs that your enterprise uses or your organizations use. Absolutely, that is possible. My idea was just to kind of share knowledge on how to codify it, how to kind of make sure that what elements are included in this particular analysis in interpreting IFRS 18. Right? That's the idea. That's the background. That's where, as I said, domain and technology will kind of come together, and that's where how do we kind of productize the knowledge and the information that one has into meaningful outputs for our friends and followers. That was the idea of the webinar.
Yeah.
We are right on time. And with that, I would just want to thank everybody for making the time to attend this webinar. We are eternally grateful to you. As a follow-up, we will send you a link to the recording. We'll send you login details of this tool so that you can kind of experience it, dabble it by yourselves. And do send us your feedback and your comments. We'd love to kind of improve and enhance. Nobody has a monopoly over everything interpretative. Every model, every kind of organization in some ways will evolve and learn. So we look forward to your feedback and guidance. Thanks once again for your support. We will be in touch. Thank you and have a wonderful evening ahead.
Thank you, Gregor.
With that, we'll close this webinar. Thank you. Thank you so much. Thank you, friends.